The South African Listed Property Index generated an annual return in excess of 30% for the year ended December 2012. Returns over longer periods have been even more spectacular and have provided investors with a surefire way of beating inflation over the better part of the last decade. In attempting to give investors more choice and the opportunity to get exposure to the sector, Stanlib have now launched their own listed property ETF, and Len Jordaan, who heads up ETFs at Stanlib, joins us in studio to discuss this. Len, thanks very much for joining us, and obviously, before we get into the details of passive strategies, you're the proud father of two twin boys as of yesterday, so
yeah,
obviously
thanks very much, Mark.
Congrats for that, and I'm sure you're going to have your hands full, not only with ETFs, but certainly with two little guys going forwards.
Yeah, thanks very much for the wishes.
Great. We just wanted to discuss the listed property ETF and perhaps just talk about, first of all, how well listed property has done over the last decade, and a little bit about the prospects. But just tell us about Stanlib's entry into this into the listed property space at this point, especially considering there is another product in the market that duplicates this strategy.
Yeah, thanks, Warren. I think firstly, you mentioned why we got into the space. Stanlib doesn't have a strategy of looking around at where our competitors are and how we can attack them. We're really looking at where our strengths lie. And we have a long history of indexation, particularly in the equity side. But indexation is a very scalable business, and it allows us to attract assets under management without necessarily employing new people, which is obviously a nice business to be in from a bottom line perspective. So we had a look around, and we think that property is the logical next step for us to get into. Stanlib's obviously got a very successful active property book, and we see this as very complementary to that offering as well.
Now, and that's a tough one, because we were very well aware of Keelan and the fantastic job that they're doing on the property side there at Stanlib. So how do you talk about how bringing in a passive strategy into an investor's portfolio, especially considering that your active team do such a good job at picking those shares?
And they do a very good job. We don't try to sell our passive products at the expense of active products. In fact, they may very well be users of our products at some stages, and they've been very supportive of our initiative. I think it gives Stanlib more presence in the property market. Obviously, active funds generally do have a size where they battle to outperform the index, and I think Keelan's funds are attracting massive flows, and I think Stanlib just wanted to have another offering where investors could go into if they were looking for a cheap, easy, accessible product that gives them exposure to property.
Just let's talk about the actual index itself, the South African Property Listed Property Index. It's an index that obviously was very small, the better part of 8 or 9 years ago, and it's been led massively in terms of its size. The market capitalization of listed property has grown tremendously. Just tell us a little bit about the details of some of those underlying stocks and the index itself.
So the index it probably lends itself to indexation more so than a lot of others because it is so top heavy in a couple of names. Active managers, if they get their bet wrong in one or two names, will battle to outperform. So I think it does lend itself to indexation. The property market as well, I think, is in for a good time over the next few years, not necessarily from a performance perspective, but from an activity perspective. There's certainly a lot more interest in property stocks given the fact that it has performed so well over the last few years. And also the JSE's got an initiative where they're trying to list some vehicles that were previously not listable that house property stocks. And we're hoping that will bring new entrants to the market and will diversify that index a little bit more.
And just in terms of being able to offer the ETF itself, it's going to be an exchange-traded fund. It's listed on the JSE. So how can investors actually access this product?
Currently, they can access it through their stockbrokers. There are a couple of LISPs that do offer it as well. We are trying to sort of unlock the golden door that will give us access to the broader market, the kind of guys that have been traditionally invested in unit trusts. But for now, it's limited to the normal channels for exchange-traded funds.
We've seen that the listed property index as a yield-paying or distribution-paying asset class is benchmarked very closely to the yields in listed bonds, for instance, and government bonds. I think is the 10-year government bond is usually the benchmark, the comparison for a yield in listed property. What are the sort of returns that you think investors can expect going forward, especially considering we've had such a fantastic run in the space over the last 10 years?
Yes, you're right. I mean, it is very dependent on what happens in the bond space and the interest markets in general. Our analysts reckon that probably in the region of 10 to 12% over the next year is a good number, although there is a little bit of risk that interest rates pick up, and that obviously the yields in bonds pick up as well, and that'll force the price of the bonds down, of the property stocks down a little bit. But we don't think that there's going to be movement in the interest rate market for the next year or so.
Okay, so at this point, interest rates are pretty benign at this stage, and there's no indication whether, from your side, that you expect to shift up or down in interest rates at this point?
I don't think so. There's been some talk about interest rates actually coming down if we get into a stagflationary kind of environment, but I don't think that anyone's pricing that into the interest rate markets at the moment.
Okay, just in terms of the actual constituents, we've seen a lot of listed property counters coming to market. So besides the really large ones like the growth points, a lot of smaller ones that are falling into that index now because they are listed property stocks. What's the challenge for you as an ETF issuer to be able to move and rebalance that portfolio with some of the smaller guys that might not be as liquid as the larger ones?
It certainly is a little bit of a problem. The smaller counters tend to not trade very much, but the advantage that an ETF has over a unit trust in this instance is that we never handle cash. So the inflows that we receive are never done in cash, they're always done in specie, which means that we don't have to go out and buy the underlying shares. They're always delivered when we issue new ETFs. So the only risk that we really have is on rebalancing days when the index rebalances. And typically on those kind of days, there is a spike in liquidity in all of the stocks, and at the current size of the fund, we don't anticipate having a problem. We'd probably have to increase by 20-fold before we start worrying about liquidity. The other point that you mentioned earlier is that Stanlib does have a very big active book, which does allow us to access liquidity pools that aren't typically accessible by anyone else on the market, and that'll allow us to call in a few favors if we need them, and we hope to maintain a tracking error of less than 10 basis points on the index.
Okay, so just for the benefit of our viewers, I mean that's essentially 0.1% that you aim to replicate or deviate from the performance of the South African property index.
Correct, and that's kind of an outside limit that we set ourselves, just so that we don't create unnecessary expectation. But I think we'd be disappointed if we did hit that number.
We talked a little bit off air about some of the, you run the Stanlib SWIX and the Stanlib 40 index as well.
Yes.
How much crossover, give or take, is there with regards to listed property in those two indices?
There isn't very much. I mean, it's in the single-digit percentage points. So if people are looking to make an allocation to property in particular, they should look to the property ETF rather than to the top 40 ETF to give them that exposure. So that what's happened recently is that people have started managing their property and their equity very separately. Or even though property stocks are listed, they're not being managed together with a normal basket of shares. So people are tending to trade those very separately.
I seem to recall a few years ago that because it's such a fantastic, these ETFs are essentially backed by some of the top properties, retail properties, industrial properties, and obviously commercial properties in the country. Is there an opportunity, and we haven't seen it yet in the local market, but it's a trend that's certainly been emerging overseas, is to use leverage within ETFs. Is this the type of ETF that maybe not now, but in the future might be agreeable to including debt and perhaps using it as a leverage ETF? Or alternatively, is it something that investors could consider using in the shape of perhaps a CFD that would give them the leverage effect that is possible with property portfolios?
Absolutely. I think property stocks are a little bit difficult to do a lot of leverage on, just simply because the market is a little bit less liquid and the stock borrowing becomes quite difficult when you're writing derivatives. But certainly in the ETF space, not for a while. I don't think we'll see leverage products for a while. But I think that there may be some warrant type of notes out there that people could purchase if they were looking for gearing. I think it's quite a scary space to be in. Gearing on the property index would take you into quite a high risk kind of scenario, but I don't see any reason why not.
Okay. From the perspective of the investor now, just bring it back into the portfolio. What's the sort of, and I know you're not a financial advisor, but how would you think about using a listed property ETF or a property strategy within an investor's portfolio?
Well, I think it's important that people are allocated to most asset classes all the time, and we've certainly seen that in the retail space. The flows into the Stanlib Balanced Fund have been massive, and certainly financial advisors are a little bit hesitant to recommend one asset class to their clients at the moment. What we would suggest for people who think that they have the ability to and are looking for a very cost-efficient method is to actually construct their own balanced fund using low-cost portfolios like ETFs. It's difficult to put an exact number just because people's portfolios should be structured around what their investment requirements are and their time of investment. But certainly we would say around about 10 or 15% or around about half of whatever your equity allocation is should be in a property fund.
And that's obviously across both an active and a passive strategy. So, I mean, this is where we come to the concept of using the satellite approach. It's one that I think that you're agreeable to, is how do you then use an active and a passive strategy within a portfolio or an asset class. You've got a fantastic active franchise. You've got now the passive side with the Stanlib Property ETF. What's your sort of thinking around how to use both of those in an investor's portfolio?
It becomes difficult in the property market, and that's just simply because the margins in property are far smaller than they are in equity. The difference between the active and the passive managers, and that's simply because the stocks, as you mentioned, further down the line aren't very liquid. So it prevents active managers from taking bets that are very far away from the index, and that's where something like a note would help, where you could buy the index as your core, and you could buy some sort of geared exposure as your satellite. But you're right, we do enjoy the core satellite approach, where people do index a portion of their money, but still maintain their faith in their active managers and let him try and outperform. So that's something that will happen, I think, when the index becomes more liquid down the line.
Now, I know there's a concentrated version of the SAPY index on the market as well.
Yes.
I wanted to get your perspective just in terms of where the ETF industry is going. We've seen, the products are almost doubled from 20 to I think close to 50 now on the local ETF scene. Are we going to see more ETFs in the property side of things, either from a concentrated version like the PropTrax 10, or is there the opportunity to do something with regards to what's happening in Africa at this point?
Africa is a very interesting space. Stanlib is very active in the African property market. I don't think that there's the liquidity. If you think that the South African market's illiquid in the property space, most of the property in Africa isn't listed, so it becomes very difficult to access, and the liquidity is virtually zero. So once people have bought exposure to those investments, they don't typically sell them. So that makes it difficult to construct a tradable index around them. Certainly going forward, that's a space that we'd love to be in, and I think Stanlib's got a very aggressive approach to Africa, and we've actually just issued a fund, not a listed fund, but just issued a fund that does give people exposure to property in Africa. So it's certainly a space that we will watch very closely, and that we think that we'll probably have a small competitive advantage over our rivals in the market.